Good afternoon and welcome to the latest Yellowstone Advisory webinar with Kenmare Resources plc, who have released record half-year results. I'd now like to hand over to Michael Carvill, MD, to start the presentation.
Thanks very much, Alex, and welcome to everybody to Kenmare Resources H1 2022 results presentation. I'm Michael Carvill, the Managing Director, and with me is Jeremy Dibb, Corporate Development and Investor Relations Manager for Kenmare. And so we'll move straight into the presentation if that's fine with you, Alex. If we could just move to slide 4, please. Just keep going. Yeah, there we are. Just to recap, Kenmare is the largest supplier of ilmenite. Ilmenite is an actually occurring mineral from which titanium dioxide pigment and titanium metal is derived. So Kenmare is the largest supplier into the world market of ilmenite. We've been in production for 15 years at our mine, and we've been growing that through that period. And we have now got to the position where we represent 8% of global titanium feedstock supply. And it's taken an investment of about $1.4 billion to actually get to this point. And part of that money was spent on 3 development projects, which were delivered in the years 2018 to 2020, which have increased the capacity of the operation to around 1.2 million tons of ilmenite product plus co-products per annum. Notable, it's just important to note that we get most of the electricity that the company uses comes from sustainably generated sources. So therefore, our carbon dioxide emissions footprint per ton of finished product is by far and away lower than any of our peers. Thanks, Alex. If we could go to the next slide, please. So we believe that we have to operate this company in a way so as to create a sustainable competitive advantage. And to do that, we use 3 particular pillars to guide our operations and management. One is that we operate responsibly. And with regard to that, we have got a lost time injury frequency rate per 200,000 man hours worked of 0. During June, we achieved 10 million man hours worked without a single lost time accident. And so I think that's a tremendous achievement by the site team. And in an industry like that like ours is quite an unusual event. We believe in delivering low cost production, and we target the first quartile on the revenue to cost curve for the industry. And we believe in 2021 we were in it. This year we are there and thereabouts, and hopefully next year we'll return to it. And then with the throw off of cash from low cost operations and a positive market for our products, we generate significant cash flow, and it's the efficient allocation of that cash flow is a critical factor in the management of the company. So thanks, Alex, if you could. We're very aware that there is global uncertainty around. We're not trying to gloss over that. There's a first war in Europe for many years. There's a rising interest rate situation in many economies. And there is increased tension between China and the United States, which could lead to trade friction. But nonetheless, Kenmare's order book for H2 is largely committed. We have seen the continuation of positive price momentum into Q3. And we believe that the situation is ripe for continuing growth in the titanium dioxide feedstock market over the long term, and particularly looking at the consumption of titanium pigment per capita in rapidly developing economies such as China and India, which is a fraction of that in the Western economies. So these economies have a long way to go before this market approaches maturity. And so during that period, we can expect to continue to see continuous growth in consumption. And turning to the next page, you've already done that. Thank you, Alex. We were the recipient of record sales prices this year. And in the first half, we got $429 per ton over our weighted average basket of products. And so that combined with tons shipped allowed us to produce an EBITDA of $106 million and a profit before tax for the half year of $63 million. So those are nice numbers. We were happy to get them. And some of the money that was generated, we spent on some capital projects. So we have been installing a rotary uninterruptible power supply system. That project is now complete. It allows it smooths out incoming electricity, and in the event that there is an outage in electricity supply, it immediately steps in and keeps our mineral separation plant working. So that's, it provides much more smooth operation of a mineral separation plant, which increases our recoveries and increases the capacity. But also it means that we do not have to put our generators on, our diesel electric generators, during the volatile summer months where we have a lot of electric storms. And consequently, we save a lot of money in diesel consumption. It also helps us achieve some of our sustainability targets, in that it helps us reduce it's a principal factor in reducing our carbon emissions by about 12%. We are conducting a study into the move of wet concentrator plant A, which is our largest wet concentrator plant, to a new zone, which occurs in 2026. That study is ongoing. The trials that we have been conducting as part of that study have all gone very well. And with that, I might ask Jeremy to give us a review of the finances.
Thanks, Michael. So on slide 9, we can see that we've had a significant uplift in our EBITDA margin, as Michael referred to, up to 58%. That's benefited from the higher revenues per ton. The freight costs have risen, but that's something which is accounted for in both our revenues and our costs, and is really borne by our customers. And so it's the FOB price that we really focus on from an operating perspective. All of that has helped to drop through to the bottom line with profit after tax of 62.5 million and EBITDA up 20% to 105.5 million. On the right-hand side, you can see the split of our products. When we mine the ore, we tend to have a relatively stable mineral assemblage, but the difference in the FOB received prices does tend to vary a little bit with shipment. So in H1 2021, we shipped less primary zircon, which meant the contribution there was lower. H1 2022 is more normalized, with somewhere in the region of 25 to 30% of our co-products generating revenues, and ilmenite typically in that 70 to 75% ratio. So a return to normal. As mentioned, the EBITDA was a record for H1. And so we're very positive in the outlook. Turning to slide 10, here you can see a breakdown of the various products, and we've seen a strong and steady increase in the ilmenite price and the overall average prices. But the uplift that we've seen in zircon for the last couple of halves has been much stronger, and that's helped to benefit our mix contribution. With regards to shipments, they were lower than in the first half of 2021, and that was primarily as a result of reduced shipping capacity due to the Brona J needing to undergo its 5-year dry docking. That's due back in the next couple of days back to site, and we would expect to catch up a significant proportion of that stock that's been built by the end of this year, although the full completion of the normalization of inventories is unlikely to be completed until H1 2023. On the bottom right-hand side, you can see the impact of that volume being 48 million, but more than offset by the price and mix benefits to lift overall FOB revenues. Turning to costs on slide 11, this is the normal breakdown that we prepare, which takes the balance sheet costs of sale and brings it back to a net cash operating cost. And so that adjusted cash operating cost halfway down, you can see grew by 16%. That was in line with our guidance. Our guidance for the full year is between 190 and $210 million. And so that 101 is bang in line with the middle of that guidance, but was impacted on a unit basis by the lower production levels in the first half, which meant that there was a rise in total cash operating costs. However, because of the higher co-product revenues, our cash costs of ilmenite production actually fell to 7%. And so in the second half of the year, we would expect to do better as we produce more and are able to reduce those unit costs further. Turning to slide 12, this shows a bridge of the net debt, which reduced by $17 million through the half. Strong operating cash flows and then additions to plant, property and equipment. The capital that we'd spent is slightly below our full year guidance and slightly higher in the second half. The working capital is mainly attributable to the increase in the finished product stocks. As mentioned, that will unwind in the second half of the year and into the beginning of next year. And then the payment of the full year or final dividend for 2021 of $24 million and $5 million of interest and financing fees leaves us with a net debt of $65 million at the half year. Turning to slide 13, just a quick review of the balance sheet. I don't think there's too much to focus on here. Really, just to say that the inventories are up as we talked about because of the finished products. So they're up 31 million, but that 27.8 related to the increase in the finished products. They're obviously in at cost. So in the second half, when they unwind, we'll also get the benefit of that 58% EBITDA margin flowing through. And beyond that, we finished the half with cash of $30 million after the dividends and also debt repayments, which began in March of this year. We made our first debt repayment of 15.7 million. That's a semi-annual payment that we'll be paying going forwards. And we also fully repaid the RCF, which we'd drawn on at the end of last year for the share buyback that we completed. And so with the cash flow generation in the first half, we've now fully repaid that, but it remains available for redraw as required. And so the final finance slide on 14, the increase in the profit after tax being up 30% is obviously fantastic, and we're very pleased with that. But as a result of the share buyback, the dividend per share is actually up 51%. So that shows the benefit of that transaction at the end of last year. And the dividend for H1 2022 was actually higher than the full year dividends for both 19 and 20, which is fantastic. The payout ratio is at 25%, which is the same as we paid last year, and we would expect the full year final 2022 dividend to be a balancing payment at that 25% level, with profitability in the second half benefiting from those higher shipment levels. And with that, I'll pass back to Michael to talk through the operations.
Thanks, Jeremy. Next slide, please, Alex. Yeah. So just on the safety performance, I just quickly mention the safety performance again. A lost time injury frequency rate of 0 per 200,000 hours worked is not an accident. That's a result of a lot of focus, a lot of determination by the management and on site, and a lot of determination by every single person working in the organization to protect the safety of his colleagues and his or her colleagues and his or herself. So we're really delighted by that. As an investor, I think it's interesting because if you can manage the detail of safety management, you can also manage the detail of operations management. And generally, safe companies are well-managed companies, and where the detail of management is under control. So if I move to the next slide. we have safety sustainability goals, and those are published in our annual report. And we work hard to achieve and continue to improve on our sustainability efforts. I won't go through all of these, it would take us too long, but just in terms of the safe and engaged workforce, we have sent 200 of the leaders, the middle managers and senior managers in the organization through leadership programs to learn how to lead better and how to coach and mentor people below them. And that has had a very significant effect in improving the quality of leadership. And again, that flows through into the safety. So thanks, Alex. Could we just hop on to the next slide? So in H1, could we move to the next slide, please, Alex? Yeah, thank you. In H1, we had some issues in terms of, no, we moved 2 slides there, I think. Yeah. So in H1, we got hit by 2 tropical storms that caused some disruption. And in Q1 and maybe the very start of Q2, we had issues with slimes levels. Now, slimes are very small particles that are present in the ore that we mine, and when they go into the mining pond, just to remind us that we mine by dredge mining in a pond. These slimes can interfere with the recoveries in our wet concentrator plants. If you're allowed to get to high level, they did get to too high level in the first half of the year. We got that under control by start of May. And since May, we have been operating at very full production levels, and we're delighted that it's running smoothly. As well as that, in H1, shipments were down. And the reason shipments were down is that we export our material by loading from our storage shed down a conveyor belt and onto transshipment vessels that the company owns. We have 2 of them. The largest of those transshipment vessels, the Brona J, was due to go to its 5-yearly refit in dry dock in H1 of this year, and it did so. And consequently, we were operating with only 1 transshipment vessel and couldn't ship out at the same rate. The consequence of this is that we've had a buildup of finished goods inventory. And we anticipate that we will release a significant portion of that buildup of inventory in the second half of the year. So in the second half of this year, in H2, we expect to be operating at a higher overall production rate. And we also expect to release a significant portion of the inventory that was built up in H1. Thanks, Alex. Could we turn to the next slide? I mentioned earlier that we're in the process of conducting a pre-feasibility study on the move of our wet concentrator plant A to a new mining zone called Naka. That move will occur in 2026. And when it goes to Naka, wet concentrator plant A will then stay in Naka for more than 20 years. So this is really and it's likely to stay there for 40 years. And so therefore this is in anyone's perspective pretty well the last move that wet concentrator plant will ever make. The pre-feasibility study is, as well as moving the plant, it is also looking at what is the optimal setup for mining when we get into the Naka ore zone, which has slightly different characteristics to the ore zone that we're mining at the moment at Namalope. The pre-feasibility study is taking quite a bit of time, and that's because we're doing extensive trials to ensure that we get the absolutely optimal setup. The trials have gone very well. They're extensive. That photograph on the bottom side is a hydro mining trial that we conducted, and you can see it's a pretty extensive digging of ore, and it was a pretty big project. but it went extremely well. And from that success of that trial has encouraged us to do another trial, which we have done. And again, that's been very successful. So we're confident that this project can be successfully performed, that we can move Wet Concentrator Plant A to Naka. And we're also very confident that we can mine Naka at low cost when we get there. And finally, last of this set of slides, Alex, if we could just turn to the next one, please. Yeah, thanks, Alex. RUPS, that's Rotary Uninterruptible Power Supply, is now that white building in that photograph there is now delivering significant benefits. It is protecting our mineral separation plant from all fluctuations in voltage and all outages in voltage since it has been commissioned. It's really doing exactly what it was supposed to do, and we're absolutely delighted with it. It's one of those projects which has both a positive environmental aspect in that it reduces our carbon emissions by 12%, but also a really positive NPV as well, because we save from burning all that diesel. And as everyone knows, diesel is going up in price. So we're delighted with the project and believe that having RUPS in place will allow us to produce more material through the mineral separation plant throughout the year. Thanks, Jeremy.
Okay, so moving to markets. On the left-hand side, you can just see a slightly longer data series here. Is the average prices across all of our products, which have shown 10 halves now of increased pricing, which is great to see. On the right-hand side, this shows global slag production and the percentage of the material that's integrated and non-integrated. And the reason that that's important is that the growth, as you can see, and the expected growth into the future is in the non-integrated production. So these are slag producers that don't produce their own feedstock. And so that's a key important market of ours and shows the increased demand for those sorts of products that we produce. And moving to slide 23, we show the global supply demand balance on the left-hand side. And what you can see here is that the green line was above the orange line from a period of about 2011 through to 2015. And this led to a growth in inventories, which is highlighted on the right-hand side. You can see that those inventories building, these are excess inventories rather than total inventories. So excess inventories in the whole value chain. And since then, the orange line has been above the green line on the left-hand side chart. And so that white area was filled in by those inventories that were previously built up through the value chain. And again, mirrored on the right-hand side with that falling inventory amount. And right now, we're at a position where we don't believe there are any excess inventories throughout the value chain. And that's part of the reason why we've seen stronger price rises in the last couple of halves. Going forwards, given the uncertainty in the world, we could see a possibility of slightly lower demand in 2023. But at the same time, existing supply is flatlining, and therefore additional new potential supply needs to get built. And in a world where pricing is weaker and with supply chain challenges and other things going on, we think that it's less likely that potential new supply comes online exactly when expected. And therefore, we see a balanced market in the next couple of years, which should be supportive of pricing. And so moving through into 2024, as Michael mentioned, sorry, slide 24, as Michael mentioned in Q3 22, we saw a continuing of the pricing momentum that we've seen in our H2 volumes are largely committed. But demand remains robust despite the uncertainties, and those low value chains we believe will support the market fundamentals. We actually saw a stronger pricing momentum for zircon, where supply remains constrained, And although the Chinese market has been weak, prices are still climbing, and we expect that, except from China, where they've moderated slightly, they will continue at these strong levels. So with that, I'll turn back to Michael for the outlook.
Thanks, Jeremy. This is a slide that is generated by an independent source, a company called TZMI, who do analysis of the titanium pigment and the titanium feedstock markets. And the reason that it's done for 2013, 2018, and 23 are those are the years that they consider. And so that's the information we have. We target a first quartile position, and we believe that we were operating thereabouts in 2021, with somewhat lower production in the first half of 22. I'd say we're just on the edge of it, but hopefully we'll be able to get back fully into the first quartile in 2022 or 23. It's a very significant factor for us in that this is a commodity market. Eventually, the very positive commodity prices that we're experiencing will turn, and there will be a down cycle. And those companies, which are at the right-hand side of this chart, at high cost, will have a much harder time than the companies that are in the first quartile. The first quartile is generally cash producing throughout the whole commodity cycle. Thanks, Alex. Could we move to the next one? And so just to recap on the pillars that we base our management on: operating responsibly. Well, we have the lowest ever LTIFR, and we now have a RUPS in operation, which is reducing our carbon output, but providing much more stable operation of a mineral separation plant. In terms of delivering low-cost production, we are working very hard to maintain cost control in a difficult and inflationary environment, and that has allowed us have an EBITDA margin of 58% in H1. And finally, that has all allowed us declare a dividend, an interim dividend per share, which is up 51% from H1 2021. We're very pleased to do that, and while simultaneously allowing us to strengthen our balance sheet and reduce our debt by $17 million. So, Alex, thank you very much. That's really what we wanted to present to the investors, and thanks everybody for listening, and we're delighted to respond to any questions that might come up.
Brilliant. Michael and Jeremy, thank you very much for that. We've had a number of questions, so we're going to take those now. And just as a reminder, if you do want to ask a question, please type it into the chat box at the bottom of your screen, and we'll try and cover as many questions as we can. So I'm going to start off. That's one that came in ahead of time, Michael. Can you please comment on the security situation in the Cabo Delgado province, and has it had any impact on Kenmare Resources operations?
So firstly, it has had no impact of any form whatsoever on Kenmare Resources operations. The portion of Cabo Delgado, which is where those insurgents were active, is about 700 kilometers north of where we are, and 700 kilometers on most beacon roads is a long way. The insurgency has been significantly curtailed by the deployment of troops, particularly from Rwanda, which have acted very quickly and smoothly and pushed the rebels out of the towns that they occupied and disrupted their bases in the bush. And so the rebels have sort of dissipated and spread out. You do get a continual spattering of incidents in that large area up in the north from time to time, but it's at a significantly reduced intensity than had previously been the case.
Okay, thank you. We've had three questions on a similar topic, which is about your prodigious cash generation and your approach to, I guess, capital allocation with regard to the balance between dividends, the tender offer, share buybacks, and a suggestion that says surely the company could afford to pay 50% rather than 25% in terms of returns to shareholders. So would you like to comment on how you think about the substantial amount of cash that you're generating and how you allocate it towards those different components?
Sure. Look, I'll make some introductory comments, but Jeremy has also got a very detailed knowledge of this area. Firstly, we believe it's very important that we have a strong balance sheet. That's a critical factor, and we believe that it's in the interests of our shareholders that we have a strong balance sheet. We have seen before the destructive effect of debt becoming ascendant in a company, and we really don't want that to happen again. So we believe that part of the allocation of the cash flow that's generated should go towards repayment of debt and therefore the gradual deleveraging of the company. That's an important factor. And then we have projects that are in the future that we have to ensure that the company has got sufficient finance to be able to perform them without straining again and without getting into a position of over leverage. But apart from that, then we're very happy to provide strong returns to our shareholders. And I think we've demonstrated that by returning about $100 million to our shareholders in 2021 through the combination of the dividend and the share buyback. I think that's, for a relatively small company, that's always a handsome return to shareholders. Our dividend policy is actually 20%. So at 25%, we are operating above the minimum of our dividend policy. And we believe that's a reasonable level to peg our normal dividends. And then we can look at what happens beyond that. I don't, Jeremy, have you anything?
Look, I think that's absolutely right, Michael. We want to pay meaningful dividends to shareholders, and we think the yields that we're currently trading on the 25% payout ratio, that is a meaningful dividend, and it's been growing strongly up 50%, as we talked about. On the other side, whilst we believe the commodity market is still very strong and the outlook is good, at some point, no doubt there will be a downturn in the commodity price, and we would like the ability to smooth that out from a dividend perspective by potentially raising the payout ratio then rather than raising the payout ratio at high commodity prices. But with any of that excess capital, as we did last year with the buyback, we thought that it offered shareholders fantastic value to buy back with a 100-year life of mine trading at very low EBITDA multiples. That was well worth doing. So it's constantly under review, and we'll keep doing that.
Got a couple of questions on the share price. A lot of people saying, I know it's doubled over the last year or so, but a couple of people saying, what are the options to close the extreme undervaluation of the share price currently?
Look, I mean, obviously the share price is set by the investors on this call at what price they want to sell or buy at. I think from our perspective, we want to continue to operate the company in the first quartile with a strong balance sheet and make sensible capital returns, be it via dividends or share buybacks. And hopefully by consistently doing that, the shares will trade up at a better level. The only thing I'd also mention is that whilst we believe we are very undervalued, I think the mining sector in general is undervalued at the moment, and that definitely plays a part in it.
Okay. Given the products are so linked to economic growth, are there any areas of the global economy that have surprised you either to the upside or the downside in terms of demand?
Not really. We're pleased that that Europe has continued to be strong despite the difficulties in Ukraine, and our customers in Europe are continuing to demand materials from us, and we're continuing to supply them. So so I think slightly on the upside, we're positively impressed by the continuing demand coming from Europe.
Okay, thank you. We've got a couple of questions on the WCPA move to Naka. The first one is, how do you envisage paying the 225 million for the move? And will the relocation of the WCP to Naka result in a reduction in output during the move? And how long will the relocation take? And then following that, what is the expected life of this WCP? And will it need replacing at some point, or will you be able to keep it on a sustaining maintenance program afterwards?
Can I sort of go through those backwards? And so we see the life of these plants as being pretty well infinite, because we keep maintaining them and replacing pieces that are no longer functioning, and so you just keep on renewing them, and consequently we don't really see why they would not continue for a very long time. Part of the question will be answered by the completion of the pre-feasibility study on Naka. So it's Naka, not Nakata. And so it's sort of premature to say, oh, this is how it's going to be, and this is how long, and this, you know, that those are the issues that the pre-feasibility study is resolving. And we expect to get that pre-feasibility study in early 2023, and really that will answer all of those issues. With regard to the expenditure, we expect that we will spend some of the money of the movement, some of the move costs, and a lot of those costs are not in the move, but in establishing infrastructure and capacity to mine in Naka, that we will spend some of them at an earlier phase rather than waiting for the move to actually happen. And we believe that the funds for that will be generated by the operation of the business itself.
Okay, thank you very much.
Just to add in, just to add to that, Alex. Just for those who might not be aware, that the move of A is quite different to the move of B. So the move of B, as I'm sure hopefully many of you have seen, and if not, check out the social media. But the move of B, there's a good video, was done by SPMT. So the whole plant was loaded and then it was driven down the road to the new location. WCPA will actually mine its way into the new location. So I think that the risk profile of that is slightly lower. And when we talk about the production impacts, because it'll mine its way there, it will mine through ore through that way, but there will be a slight reduction in production in that year as it mines its way there. But as Michael said, the precise outcome of that will be released with the PFS in early 2023.
Okay, thank you. A couple of questions here on production. So production was a little disappointing in half one. What steps are you taking to ensure an improved outcome in half two? And then I guess a comment on the slimes. Q2 production was impacted by slimes, and can you outline the steps you can take to reduce this impact going forward?
Yes, we manage our slimes by a set of paddocks that are arranged behind our active mining pond. In H1, in H2 last year, toward the end of last year, we had to do a very acute turn because of the geography of the ore body. When we did that turn, it meant that then we were left in a situation where our paddock system was compromised. We didn't have enough space to have as much settling room for slimes as we would have preferred. And it took us a while to work out through that and get our 3-paddock system back in place. The 3-paddock system is not back in place. It's been back in place since really the start of May, and our operation is working just fine.
Okay, thank you. You mentioned that ilmenite prices have improved for a number of consecutive quarters. As you look towards the second half of the year, what are your expectations for ilmenite prices? And can you talk about how much production you sell under contract and how much you sell at spot prices?
So our expectation for the second half of the year is positive. We believe prices are and demand is high, and we have allocated most of our production already for the second half of the year. Pretty well all of our production is exposed to the market price. We don't have long-term fixed price contracts. So the volume contracts that we do have are repriced twice yearly, so every 6 months, back to a market price. And so therefore, in general, there's a lag effect. And so as we're going forward and the price is increasing, we tend not to get the same value as people might find on a Bloomberg screen or something like that, because our prices were fixed 6 months beforehand. But in general, despite other than that lag, we really are exposed really 100% to market prices.
And then I guess a follow-up to that is, can you talk a little bit about customer concentration? And is the customer concentration as a percentage of revenues planned to change materially going forward?
That's an area where it's one of our strategic goals to ensure that we do not have a very large customer concentration. And over the last couple of years, we have been expanding our set of customers quite considerably. And at this stage, I think we have about 20 customers, and the biggest customer taking about 12-15% of our ilmenite supply, which is 70% of our total revenues. So somewhere about 8% of total revenues.
Okay, thank you. And just a reminder, if you do want to ask a question, please type it into the chat box at the bottom of your screen. We've got time for a couple more questions. How much TI2 demand is from climate change related sources, i.e. white paints, etc.?
Well, so if you look at total demand for titanium, 5% is metal, some of which goes into things like turbine blades for wind power and things like that. 5% is used for welding applications. That's mainly for shipbuilding, and then 90% goes into paints, paper, and plastics. All paint starts as white paint, and I think paint makes up somewhere around 60% of that 90%. But I don't have a figure for exactly what percentage of that white paint is due to eco reasons.
I suppose just as a sort of slight aside, just to say that I don't know if everyone realizes that our mineral sands concentrate contains monazite, which is the precursor mineral to rare earth oxides. And so basically we're a supplier of the naturally occurring mineral for rare earth oxides, which are then used to manufacture magnets for electric motors. So in other words, you don't get to have electric cars and windmills and all that stuff unless you have magnets for the electric motors, and the rare earth oxides are a key factor in the generation of those magnets.
Okay, thank you. I've got a question here on your costs. What sort of cost inflation are you experiencing at the mine?
Well, so as we talked about, the actual cash operating costs were up 16% year on year, and our guidance for the year was 210, or at the top was 210, but 190 to 210, and we're right in the middle of that at the moment. So I wouldn't say that all of that 16% is as a result of inflation, but we are experiencing inflation as everyone in the world is at the moment. And so I don't have a specific inflation figure to be able to give you, because we have a multitude of different volume and pricing elements going on in that 16% increase. But at the moment, we think that our cost guidance for the year is something which we'll be able to meet.
Brilliant. That brings us to the end of today's webinar with Kenmare Resources. Michael and Jeremy, thank you very much for presenting and answering all those questions so clearly. And just as a reminder, as you exit today's webinar, you'll be asked to complete a short feedback survey. It'd be really appreciated if you could do that. It will only take you a couple of minutes. And finally, thank you everyone for attending, and we hope to see you all soon.
Thanks, Alex. Thanks, everyone.
Thanks, Alex.
Cheerio.